Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Good morning and welcome to Modern Investing Techniques, episode 85. It's June 23rd, 2026, and I'm Patrick in Vancouver. Time to break down today's market setup and find our edge. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Oil price weakness from easing Iran tensions gives Canadian energy investors a chance to reassess exposure before next Bank of Canada decision. The S&P 500 closed at 7,473, down 0.4%. The NASDAQ Composite closed at 26,167, down 1.3%. The TSX Composite closed at 35,002, up 0.1%. European shares opened lower on rate hike bets and tech weakness. Japan's Nikkei 225 fell 3.46%. Oil prices declined as investors assessed U.S.-Iran developments, with Citi noting the conflict overhang is disappearing. The Bank of Canada's next interest rate announcement is scheduled for December 9, with markets pricing limited near-term moves. Earnings season remains active with focus on revenue strength. 15 days ago, we picked LLY on next-generation obesity data, and it closed up 0.17%. A reminder that single catalyst entries can still lag when sector rotation accelerates elsewhere. Now, let's turn to one professional approach for navigating earnings strength inside this choppy environment. Barclays raised its S&P 500 year-end target while betting on earnings strength even as the backdrop stays choppy. This approach focuses on forward earnings revisions rather than broad index multiples, allowing investors to isolate companies where revenue beats are likely to exceed consensus. In today's environment of mixed global equity performance, the tactic involves screening for names with upward earnings revisions in the last 30 days and pairing them with sector ETFs that show relative strength on a 10-day basis. Implementation is straightforward on platforms such as Wealthsimple or Questrade using free earnings revision screeners and volume filters. The method has historically delivered excess returns during mid-cycle expansions when earnings visibility improves. It carries the risk of being whipsawed if macro shocks override company-specific data. Investors should therefore set a hard stop at the 20-day moving average once the position is entered. That same earnings revision discipline is exactly why we are holding fire on new trades right now. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment update shows no new position opened. We are waiting for a volume confirmed setup on a name with upward earnings revisions. The technical setup requires any tech name to close above its 50-day moving average on volume 1.5 times the 20-day average. Current session volume across the sector remains below that threshold. Entering without the volume filter risks the exact lag seen in prior healthcare and other sector trades. Maximum acceptable loss remains caped at 6% via a mental stop at the 20-day moving average. The target would be plus 3% to plus 6% once criteria are met. Confidence level is low because only one factor, the earnings revision signal, is present while volume confirmation is still missing. This pause demonstrates how to wait for the second confirming variable before committing capital, turning an otherwise noisy headline into a disciplined filter. Listeners learn that skipping a trade when the full setup is absent preserves both capital and analytical edge for the next high-conviction opportunity. While we wait, here's a quick look at yesterday's trade and what the missing data taught us. Last weekly hold was ION. Market data was unavailable for evaluation. Without closing prices, we cannot measure whether the leadership change catalyst produced any excess return relative to the broader market. The lesson learned is to require closing price confirmation before declaring any catalyst trade complete. This is the exact scenario where our earlier rule about volume confirmation would have helped avoid ambiguity. Discipline around data also shows up in day-to-day execution mechanics. Now, here is something that most retail investors get wrong, and it cost me money before I figured it out. Imagine you bought an ETF tracking Japanese equities last week when the Nikkei 225 was already sliding. Your order filled at the ask, but the quoted spread had just widened from 4 cents to 18 cents in the first 20 minutes of trading. The mechanism at work is liquidity withdrawal by market makers when overnight news such as rate worries and regional equity weakness increases perceived risk. The displayed bid drops faster than the ask can be hit. What most retail investors do not realize is that the effective spread you actually pay can be 2 to 3 times the displayed quote once you factor in the depth at each level. Checking level 2 data before market open reveals whether the inside market is one-sided. The professionals always compare the current spread to the 20-day average before entering. If it is more than 50% wider, they either wait or use a limit order at the midpoint. The biggest mistake with spread dynamics is assuming the posted quote is the cost you will pay. Instead, always pull up the time and sales tape for the prior 15 minutes and size your order to no more than 20% of the visible depth at the bid. Tools that quantify hidden risks are becoming more accessible to Canadian investors. Measurable Now delivers estimated CRREM misalignment year scores for roughly 370 global IIETs and REOCs. This gives investors a standardized way to quantify climate transition risk at the security level. Canadian TFSA holders focused on real estate exposure can use the misalignment year metric to screen out names projected to fall short of net zero pathways by 2030, reducing the chance of future regulatory or valuation shocks. Access is available through Measurable's enterprise tier or via partnered research portals, with the free tier providing summary scores for the largest 50 names. EBC offers transparent FX slippage data for RRSP hedging. The platform's transparency features let users see exact slippage statistics per currency pair, which is useful when hedging U.S. equity positions inside an RRSP. Retail accounts start with no minimum deposit and commission-free FX trades up to certain volume tiers. Both tools are aimed at TFSA and RRSP users screening for climate or cross-border risk. European stocks fell as rate worries eclipsed the Iran peace deal. Rate hike expectations are pressuring European equities even as geopolitical tensions ease, creating relative value opportunities versus North American indices. The action item is to add a small position in a broad European ETF only if the Euro Stoxx 50 closes above its 50-day moving average on above average volume. Source reports from investing.com highlight how the peace deal developments have been overshadowed by monetary policy concerns from the Federal Reserve. Investors monitoring the Euro Stoxx 50 are advised to wait for volume confirmation before committing capital in the current environment. The decline in European shares reflects broader caution across global markets outside of North America. This setup allows for potential mean reversion if rate hike bets moderate in coming sessions. Oil prices fell as investors continue to watch U.S.-Iran moves. Declining oil prices reduce immediate inflation pressure but also compress margins for Canadian energy producers. The action item is to trim energy holdings by 5% if WTI closes below $70 for 2 consecutive sessions. Source reports from CNBC.com note that the easing of tensions has removed the conflict overhang previously supporting prices. Canadian investors holding energy names on the TSX are monitoring the next Bank of Canada decision scheduled for December 9. The price decline follows assessments of U.S.-Iran developments that Citi described as the conflict overhang disappearing. Producers face margin compression that could affect quarterly revenue strength during the active earnings season. This environment gives TFSA holders an opportunity to reassess exposure levels ahead of potential further moves. Singtel raised $773 million, selling 2.8% of its Gulf development stake. The sale frees capital for reinvestment or shareholder returns, illustrating how large telcos monetize non-core holdings. The action item is to place Singtel on the watch list for any follow-on dividend increase announcement within 90 days. Source reports from financialpost.com detail the exact stake percentage and proceeds from the transaction. The move demonstrates a strategic approach to portfolio optimization by divesting non-core assets. Canadian investors tracking international telecom names can monitor for capital return signals in the coming quarter. The transaction size of $773 million provides a concrete benchmark for similar monetization strategies. Follow-through on dividend policy would offer additional income potential for holders in tax-advantaged accounts. Citi named top picks in the Japan electronics sector. Sector-specific upgrades can highlight names with improving earnings visibility amid broader market weakness. The action item is to screen the 3 Citi picks for 14-day RSI below 40 before considering any entry. Source reports from investing.com identify the upgrades as focused on earnings revisions within the electronics space. Japan's Nikkei 225 closed down 3.46%, creating a backdrop where relative strength screening becomes relevant. Investors can apply the 14-day RSI filter to avoid names that have not yet reached oversold conditions. The upgrades arrive during a period of mixed global equity performance that includes European rate concerns. This sector focus aligns with screening tactics that pair upward revisions with technical confirmation on platforms such as Questrade. Finally, here is your action item for the day. Open your brokerage screener, set earnings revision filter to upward in the last 30 days, and volume filter to greater than 1.5 times 20-day average. Then export the top 5 tech names that also sit above their 50-day moving average. Before we wrap, keep an eye on whether any tech name delivers the missing volume spike tomorrow morning. That's modern investing techniques for today. If you found this useful, share it with a fellow investor and subscribe wherever you listen. Check the resources page for tools and platforms we discussed. We're back tomorrow. Keep learning, keep investing, and if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give Models and Agents for Beginners a listen. Artificial intelligence explained simply for beginners and curious teens. You can explore the whole lineup at neuranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?